Hey everyone, this is Robert Weinberg, your mortgage advisor and financial coach. In today's lesson, I want to talk about the recent Fed rate cut and what it means to your mortgage. So, July 31st, 2019, the Fed actually cut the federal funds rate for the first time since 2008. So, over a decade. A lot of hype in the media about this, a lot of things online, people talking about it. But how does it actually affect your mortgage? It really doesn't affect your mortgage directly. So let's talk about that. The federal funds rate actually controls short-term rates. The federal funds rate technically is the rate that banks pay to borrow money overnight. So it's tied to the prime rate and to short-term rates, which are like credit cards, car loans, home equity lines of credit, and your savings account at your bank. So you may see a little bit of a downward trend on your credit card interest rate, which is good, but at the same point, you may also see your savings account interest rate go down too as a result of this. Mortgage rates are actually tied to U.S. Treasuries because these are long-term loans, 20-year, 30-year type of mortgages, even 15-year mortgages. They're all tied to these long-term U.S. Treasury bonds and the rates of those bonds. So while there may be an indirect correlation with this, as we'll talk about, there's not a direct impact on mortgage rates. I had clients and realtors calling me yesterday after this Fed rate cut saying, Rob, did my rate just go down 0.25%? Is my mortgage rate lower? No, it's not. And the crazy thing is that we knew about this for a while. I mean, most of the economists I follow, like Barry Habib, has been talking about this rate cut for over 30 days, maybe even 2 months or more, that we've known that this was coming. The markets priced this in. It was nothing out of the blue. There wasn't anything crazy going on where this was unexpected. So the market had already priced it in. Mortgage interest rates have been on a downward trend. So they already knew this was going to happen, and everything's already been priced into the market. So nothing really changed when this actually occurred and the announcement was made. The question is this a one-time drop or is this the first of a series? And they talked about that in the announcement by the Fed. It's really hard to tell. At first, the Fed chairman said it was a one-time, but then kind of backpedaled later in the speech and said it may, based on the economics of it, it may be a series of cuts depending on the economy and the different things that they look at to determine that. So as Barry Habib, one of the main economists and experts that I follow, has talked about, a recession is likely on the horizon. We're in the biggest economic expansion in the history of the United States. So it's really likely that we're going to see a recession come in the next 12, 24, 36 months at the most. So realize that historically, mortgage rates have gone down during recessions. So what you want to look at is what your mortgage strategy is moving forward. If you have an opportunity to refinance right now and it makes sense, you do want to do that because there's no guarantee what rates will be in a year, 2 years, or more down the road. So if it makes sense, do a refinance now. But the strategy and the key behind this is that you don't want to pay a bunch of points to buy down your interest rate right now. Because if there are lower interest rates in a year or two, you're going to want to refinance again. And if you paid a bunch of fees and costs to buy your rate down, you're going to be kicking yourself. It's not going to be a good investment. The key behind that thinking is that when you pay extra points and fees to buy your interest rate down, you're going to need time to recoup that cost. It's a return on investment. You're going to need time for that investment to come back to you in the form of increased savings on your mortgage. So if you pay a bunch of fees now and refinance again in a year or two, it's going to be a negative return on investment. You're not going to have time to make your money back. So the strategy is take the interest rate that you can get right now without paying extra points and fees. Talk to your mortgage advisor in depth about the strategy and make sure that they're not tacking on these extra points and fees to get you a lower rate. Just take what we call the par rate, or the rate that wouldn't require extra points, and then if rates do come down here in the next year or two, like they're saying, if we go into this recession like they're talking about, we keep seeing rates go down to historical lows, then you have that opportunity to refinance again, and then you can look at maybe paying extra points or getting that rate down to that bottom dollar. Once we're in the recession and the rates are at the historic lows, that's when you want to look at really capitalizing and making that long-term move. But for right now, just take what you can get on the interest rate. They're very close to historic lows, and don't pay the extra points and fees. So hopefully this strategy has helped you, and hopefully this information gives you a little bit of clarity on what this Fed rate cut means to you and your mortgage. Appreciate you watching, and if this is of interest, please follow me on social media, Facebook, Instagram, Twitter, LinkedIn, and my YouTube channel. Like this post, comment, share, subscribe to my channel for more, and we'll talk to you soon. Thanks for watching.